WHSmith priced its emergency share placing at 410 pence on Wednesday, raising £106 million at a level that crystallized what the market had been pricing through a 60% annual decline. Not a cyclical softening, but a structural question about whether airport retail built around US and Middle East routes can hold its earnings base while the Iran war runs. The profit guidance came in at £75 million to £90 million for the year ending August, down from £90 million to £105 million in April, and from £100 million to £115 million before that. 3 cuts in 3 months. Each revision landed after the same cause, observed and anticipated passenger decline from Middle East conflict, but the board's language shifted in this update. The assumption is now explicitly that jet fuel supply can be maintained and that consumer confidence will not recover near term. That framing concedes the war is not priced as an event, but as a baseline. The capital flow that preceded the placing tells the structural story. Causeway Capital Management, WHSmith's leading institutional shareholder, subscribed for 6.5 million shares at 410 pence, £26 million, rather than allowing dilution to pass entirely to new entrants. That decision matters not because it signals confidence in recovery, but because it prevents a clean holder class shift. Causeway subscription at placing price means the institutional anchor held position rather than rotating out. Retail shareholders who did not participate in the placing absorbed 20% dilution without the same blended cost basis. The share count rose by 25.8 million, and the FRC's concurrent launch of a formal audit investigation into PwC's WHSmith accounts compounded the discount, adding governance overhang on top of the trading deterioration. North America is where the compression is sharpest. Like-for-like sales in U.S. airports fell 4% in the final 7 weeks of the period, and casino operations declined 11%. The company is restructuring by selling, exiting, or renegotiating loss-making contracts, and replacing directly run stores with franchises in subscale markets. A non-cash impairment charge of up to £150 million is anticipated for the year. What the new guidance does not resolve is whether the 5% headline trading profit margin assumption for North America holds if passenger numbers continue to contract, and that margin assumption is the single variable that determines whether the revised £75 million to £90 million range itself proves optimistic.
The question WHSmith's distress raises, whether Iran-driven travel compression is now a structural repricing condition for UK-listed names, ran directly into its contradiction on the same morning. DCC, the Dublin-headquartered, London-listed energy distributor, announced that its board is minded to recommend a takeover proposal from KKR and Energy Capital Partners at 6,672 pence per share, a 33% premium to its 3-month volume-weighted average price before the first approach in late April. The bid escalated 15% from the consortium's initial proposal. KKR and Energy Capital Partners now have until 8 July under Irish takeover rules to table a firm offer or walk away. The PUSU deadline was extended at DCC's request to allow limited confirmatory due diligence. DCC shares rose 3.3% to 6,200 pence on Wednesday, still trading 7% below the proposed price, which means the market is pricing meaningful deal risk rather than trading the minded to recommend language as a done transaction. The capital flow here runs opposite to WHSmith's. Institutional holders who had been selling DCC during years of underperformance relative to analyst targets, DCC was among the smallest FTSE 100 names by market cap earlier this year, now face a price path determined by arbitrage positioning rather than fundamental selling pressure. Berenberg raised its target price to 6,700 pence on Wednesday, 1 pence above the bid level, which signals the sell side is no longer competing on fundamental valuation but on deal probability. Foreign private equity, specifically U.S. capital, is the buyer class entering. Domestic UK institutional holders who remained through the conglomerate disposal process are the exit side. DCC's strategic logic deepens the contrast with WHSmith. The company spent 2024 and 2025 shedding healthcare and technology assets to concentrate on energy distribution and energy transition. Energy Capital Partners specializes in electricity and sustainable infrastructure. The bid premium is not for DCC's historical earnings stream, but for its energy transition positioning. That positioning is exactly what the Iran war makes scarcer. If the conflict sustains elevated oil prices and accelerates the urgency of energy diversification in Europe, the assets KKR and ECP are acquiring become more competitively valuable, not less. The 33% premium is not disconnected from the Iran-driven demand shock. It reflects a different participant class reading the same geopolitical signal in the opposite direction.
easyJet's share price has risen 21% in the past month from a multi-decade low, and Deutsche Bank's upgrade to hold from sell with a revised target of 540 pence against a prior 340 pence captures what that recovery actually is, a positioning adjustment, not a fundamental re-rating. The airline's first-half results through April showed the Iran conflict had already added £25 million to fuel costs in March alone. Expected first-half pre-tax loss widened to £540 to £560 million, well above the prior market forecast of £421 million. Load factors at 90% held, but bookings weakened as consumers tightened spending, and oil at $111 a barrel pressed on every forward yield assumption. The fuel bill runs at roughly a quarter of revenue, which makes easyJet more oil price exposed than network carriers with hedged fuel programs and larger balance sheets. The share recovery from that trough reflects retail and speculative positioning absorbing an exit by institutional holders, who had reduced exposure across the prior 12 months of decline. The price-to-earnings ratio compressed to approximately 5, which made the stock mechanically attractive to value screening flows even as the fundamental earnings trajectory remained negative. Deutsche Bank's upgrade formalizes what the price action already implied. The sell side is acknowledging that the extreme discount pulled in enough buying to establish a base, not that the underlying business has resolved its margin problem. The WHSmith placing at 410 pence, pricing airport retail as a distressed equity raise, and easyJet's 21% bounce from its floor are not contradictory signals from the same Iran war shock. They describe two different participant classes responding to the same disruption on different time horizons. WHSmith's institutional shareholders are marking down a travel-dependent earnings stream in real time, absorbing a dilutive raise to hold positioning. The speculative flow into easyJet is pricing mean reversion from a price level 79% below its 2015 peak, betting on recovery before the next set of fundamentals arrives. The verification point is easyJet's summer schedule delivery. If it operates the full program it has committed to, the low base recovery trait maintains its logic. If jet fuel supply disruptions force capacity cuts, the same participant flow that lifted the stock 21% exits without fundamental support, and the WHSmith pattern, repeated guidance cuts as the war's duration is repriced from event to baseline, becomes the relevant precedent. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.